Great. Welcome to Target Professional Consult. Today we are going to look at IAS 12, income tax. That's the topic for today or the standard for today. Then this version is for the principal or the tuition purposes. Please follow us or join us when you are solving the questions. That's a practice stage. Good. So principle, practice, and revision. These are the three stages in our service. Good. Kindly subscribe, like, and share the video, the link to your friends to help them. And let's go straight to today's edition. IAS 12, International Accounting Standard Number 12, Income Tax. Good. Income tax. That's IAS 12. Now with IAS 12, before I start with the income tax, I'll talk about two items. Just let's see. Tax. What is tax? Tax. In fact, there are two types of taxes. So in fact, the tax lawyers or the students will tell you is a compulsory what? Payment made by what? General public to what? The government, right? Citizen to government. Okay. For the definition, we are not interested because for financial reporting, we are interested in what? The principles and then the practice section. So you're interested in how to be accounted for in a book. Good. Now there are two types of taxes. They are direct and what? Indirect tax. Good. Now let's cite some examples of what? Indirect tax. Give me some examples of indirect tax. Example include the VAT. That's the VAT. For the indirect tax is also called the consumption tax. Consumption. Here, the tax can be shifted or the incidence can be moved to a different person. That's the final consumer. It's on consumption. Yes. So all the indirect tax, normally the one who pays the tax is the final person to consume the product. Yes. So VAT, that's the most popular or common form of the indirect tax. Can also talk about the Get Fund or the NHIS. That's the National Health Insurance Scheme. The 2.5% and then the 2.5% for that of Get Fund and then the NHIS. In total, giving us the 5% VAT of 12%. But you don't need to know all these percentages. So VAT, let me add the Get Fund to it. Get Fund and then the NHIS. Good. NHIS. Oh, that one didn't come. Don't worry. I'm aware of it. It also talks about the duties. All the duties. The duties, there are three. What are they? Import duties. So import duties, they are the taxes or a special VAT that you pay on the goods, on imported goods. When you import goods into the territories or to the country, you pay duties. That's the special VAT on it. Then we have export duty. Export duties. So export duties, they are the one that when the goods are moving outside the territories of the country. But if the goods are moving from Ghana to anywhere, you have to pay some tax on it. That is it. Then you can also have excise duty. Excise what? Duty. Here, this, in fact, we have imported goods and then we have the exported goods. Now, what about the locally manufactured goods? So, for locally manufactured goods, such goods, the tax that you pay on it are called excise duty. Good. All of these are what? Indirect what? Tax. It also talks about the service tax, or the CST, communication service tax. Probably when you talk on phone, government takes its commission or its tax each airtime that you purchase, the bundle, the data, and recently this became a news or a case in Ghana where the value was moved from 6% to 9%, and then the deductions were made directly and brought a whole lot of issues. We are not going to probably go into detail. Now let's give examples of direct taxes. Here, the direct tax is on income. Direct tax on income. It's not on consumption. It's what you've earned. It's not on what you've consumed. So with the direct tax, it's on income of a person or a corporation. So examples include one, the payee, pay as you earn. The personal income tax that you pay. We also talk about the corporate tax, tax paid by the companies. So corporate word tax. It also talks about property tax. So property tax. Now let's give another example. It also talks about gift tax. Yes, gift tax. And then it also talks about tax on realization of what chargeable assets. So all of them are there. Now, for the purpose of your study, IAS 12, it only explains how you should account for the corporate tax expense that you see in the profit or loss. That's all. How to determine it. So that's the scope of IAS 8. Even though there's tax there, it is limited to what? The corporate tax. Tax paid, or the tax that are recognized or recorded in the income statement of company. That is it. However, your examiner assumed that you are familiar or you've done VAT, because VAT is level 1 financial accounting. VAT is part of the level 1. So for level 2 or IAS 2, you're not going to consider that. So only the corporate tax. So now that we know that all this, don't need to worry about yourself about direct, indirect. There are so many, but the specific one we are going to look at after is the taxes paid by the companies. How do they record taxes paid by a company? How do we account for tax issues by company? Company tax, that's all. Not the VAT. Good. So now, let's now start again. First, the income tax expense in the financial statement comprise of three items. If you understand these items, you are done. So when you say income tax expense of every company is made up of what, three items that go with an acronym code. So C, U, or O, and then D. If you add these three items together, you are done. That is the income tax expense. The C refer to current year tax provision. Current year tax provision. So much. You can also call it corporate tax provision for the year. Corporate tax provision for the year. So that's another name. How we get it. Good. The U is under or over tax provision. Under or over tax provision. If it is under, you add. If it's over, you subtract. And finally, movement in deferred tax. Movement in what? Deferred tax. So much. So this is the income tax expense. So the income tax expense that we are going to include in the financial statement or taken to P&L is this figure. So income tax expense taken to where? P&L, the profit and loss. That's it. Great. Now let's take them one after the other and do justice to them. The first two are not difficult. The last one is the one that poses a little challenge. So let's see. C, current year tax provision. Current year tax provision. Now, this, the tax that we, in fact, let me start by saying this. We are preparing our financial statement for, let's say, 2019. We are preparing the financial statement for 2019. We've reached tax. No, the law has not given us the mandate to determine the tax that we will pay. No, not at all. We should determine the final tax that we will pay. No, that one is not in our hands. But it means that GRA or the tax authority, they are waiting for us to furnish our financial statement to them. They will scan it, go through, or they will examine it and determine the right tax. Meanwhile, we are paying a financial statement. We can also wait for them. And without a financial statement, they cannot determine the tax that we should pay. So what do? Okay, then let's provide. Let's make a provision. Let's make a provision or estimate. So anyway, you see the provision, you can also put estimate there. Current year tax estimate or corporate tax provision, corporate tax estimate for the year. Good. Now let's give a provisional figure. Okay, let's put just thousands of this in a book and let's submit the account. Let them go through. Next year, they will tell us the right tax and then we do the reconciliation. Good. So it means that the current year tax provision, it's an estimate that we have made based on the profit that we had. So let's assume that our profit before tax is 20,000. Our tax rate, we know that is 20%. We are in 20%. So that's profit before tax, which is what, 20,000. Our tax rate is what, 20%. So therefore, the tax that we are likely, looking at our profit, the tax that we are likely to what, to pay will be 20% times the 20,000. Ideally, that will give us, good, I like that, 4,000. So the current year tax will be what? 4,000. So that's the provision. It's a provision estimate, not the actual. Then we send the financial statement to the tax authorities. They will do their own examination. They will finish and they will tell us the right tax that we have to pay. Good. So that's what we call it provision, not the final. That is it. Now, it's an estimate on the profit. Estimate on what? Profit before tax. That is it. Estimate on profit before tax. Good. Now, let's see. In a final account, where do you see this? In a financial So in the final account preparation, one, it can be given to you in a trial balance. So you can see this in a what? The trial balance. Just that when appear in the trial balance, when it appear in the trial balance, it normally come with a different name. We call it tax computed on taxable profit. So tax computed on taxable profit or income tax expense. If you see it in a trial balance, that's the current year tax provision. And once you submitted it here, or once you recognize it in the income tax expense, ends there. Because the items in the trial balance normally treated what once. So if it's in a trial balance, so trial balance, so they can give it to you in a trial balance. So if it's in a trial balance, then after you bringing it here, it ends there. You are done. That's the end. Now this will not be the case always. No. Because we said that it's a provision, and most of the provisions are made in a footnote. Most of the provision we pass note. So if it's in a footnote or in additional information, if they give it in additional information, then it must be treated how many times? Two times. First and second. First, it must be added to the income tax expense here. So that's the side. So add to the income tax expense. So income tax expense. Let's shortcut. Now, once it's a provision, it's not paid. Provision, so it becomes what? Liability. So you add it to current liability because it's a provision that you have not paid. Good. So that is it. So I am done with the C. That's all. We are done. So we back it with what? With illustration. The C. So when I'm done with all of them, we'll pick some few illustration questions and then we deal with them. Just that this section is for tutorials or principle. We are just explaining the issues. So the next section, we are picking questions on what? IAS 12. Kindly join us or get the next video and then go through how we will solve the questions. Good. So that is it. Now let's go to the next aspect, which is the under or the overtax provision. Under or overtax provision. Great. Good. Now we said that the current year tax is an estimate. Is what? Estimate or it's a provision. It's a guesswork. Good. It's not the actual. So if you're in 2019, then 2018's financial statement, we did a guesswork there. But for now, for 2019, the actual one has been determined by the tax authority. So it means that we have to compare what we estimated and the actual tax agreed by what? The tax authority. And see if there are differences. Then we what? Reconcile the difference. So I normally call this guy a tax reconciliation statement between what you provided and what the tax authority say is what? The right tax that you're supposed to what? Pay. That's it. So that's the under or over tax provision. So either you provide more than what you're supposed to, because an estimate, or you are going to provide what? Lesser than what you're supposed to. So let's see how we can do this. So in fact, two items that we look at for. One, tax provided. Tax what? Provided so much versus, let me take the top section and make it clear, right? Be fine. You'll be fine. So under or over tax provision, under or over tax provision, one, you compare two items, tax provided. Tax what? Provided. Tax provided. Then final or agreed. Tax agreed. Final tax or agreed tax. Good. Final or agreed tax. Good. Good. So final or agreed tax. So this is coming from where? The tax authority. And it's coming from what you provided in your books. So if these two are not the same, to create under or over, so you have to reconcile so that they'll be the same. So much. Now let's give an example. You find the difference between this. That will give you what? The under or the over tax. Good. So under slash over what? Tax provision. That is it. Now let's see. Let's assume that a certain period in 2018, please, this is for previous period. Let me make it clear. Under or tax, you can only confirm or you can only reconcile the previous year's tax, not the current year. So if you are preparing the account for, let's say, 2019, if you are preparing for 2019, in fact, 2019 tax, you cannot reconcile it. You can only do the estimate. So you can only reconcile what 2018 tax, because when you're preparing 2019 financial statement, 2019, the final tax will not be ready. It's ready in 2020. Good. So that is it. So under or over tax provision, the reconciliation is normally we bring the tax you provided for last year, immediate year, tax provided for what last year or the previous year, last year or previous year, versus the tax that final agreed by the tax authority. In fact, they can add paid to any place. They can say tax provided and paid for. Final tax agreed and paid for. They can add it to any place and you're fine. Good. So if it is under, you add it. If it is over, you do what? You subtract. So under, you add because an expense. Why? Because last year the tax that you provided was what? Lesser than what the tax authorities agreed on. So that means come and top it up. It's an additional expense to you. But if you provide more than what the tax authority, it's a gain. So you subtract it from your tax expense. So that means next time when you come in, you have to probably pay just the difference, right? Good. So let's assume that here the tax provided is 1,002. Tax authority say no way your tax must be 2,000. So what do? You have what? Under provided by what? 800. So you add it. You are done. It ends there. Now, sometimes either they'll give it to you in a trial balance and explain it in a footnote for you. This is the footnote version. In a trial balance, the examiner will not state whether it's under or over. You have to use the balances. But when we say under, we've solved the question for you. So what we do is this. Check under. Under means expense, and all expense have what balance? Debit balance. So if you see the word current tax, so current tax in a trial balance. If you see current tax in a trial balance, if you see what? Current tax in a trial balance, check the balance that it's. If it's a debit side, that means under. It's an under. If it's at the credit side, that means what? Over. That's all. So if you see current, there are so many types of tax that you're going to see in the trial balance. But the one that we're going to talk about is what? Current, not deferred tax, not tax liability. No. So that's current tax rate. Now that is it. We are done with the under or the over. Let's go to the troublesome guy for the year. For the deferred tax is the one that creates the issue. Is the deferred tax. So let's go to the deferred tax. Right after deferred tax, then we are done with the IAS tool. Go ahead on with the first two. The first two, they don't pose too much challenge. It's the deferred tax that pose the challenge. Now let me do the entry again. We said that the income tax expense is made up of three items: C, U, O, and then the D, right? So maybe so much, so much, so much. So this is what goes to the P&L. This must be taken to what? P&L. Great. Now, we know how to find this. We know how to do this. Let's read this guy. Now, with the deferred tax, it's a movement. In fact, we call it movement. And movement simple means the difference between the opening balance and closing balance. So you have to do a working again. So workings within workings. We call it deferred tax. So deferred what? Tax. Now you analyze it nicely. Tell the examiner the opening balance. Open what? Balance, or the balance brought down so much. Bring the opening balance here. Go to the footnotes. The closing balance will be there, will be available. Pick it. Then closing balance. Nothing like this. Now the question is this. What should you do to the opening balance so that you can get the closing balance? The movement between the opening balance and the closing balance must what goes to the P&L. So here I record P&L into brackets the different, the balancing figure. Then you put it here. How we get it? Yes, the balancing figure. It goes to P&L. So this figure is the one that we are going to what? Record here. Good. So the movement goes to the P&L. The closing balance go to the financial position. So this figure will go to where? The financial position. The balance sheet. It will go there either as non-current liability or non-current asset. So the closing balance can be non-current liability or non-current asset, depending on the type. We are going to look at all this right after here. So the line where this is the movement. Now let's try and come up with some few illustration. What if the opening balance is 20, closing balance is 25? What will be the movement? Yes. Yeah, you had it correct. That's 5. Great. Downward. So 5, I'll add there. That when I come here, will be what? 5. This one goes to where? Non-current liability in the financial statement. You are done. That is the entry. How we get it? Good. Now let's start the massage. What if here? Here is closing balance is 18. What if the closing balance is what? 18. The closing balance is what? 18. So that means 2. I have to subtract 10. So when I come here, I also subtract 2. As it is here. That's all. So this one goes to what? Non-current liability. In that order. So that is it. Then let me do my last two illustrations. What if opening balance is 25, closing balance 25? What will happen? Both the opening and closing balance are the same. That means here nothing goes here. Dash. There's no movement. There's no what? Movement. Here there's no movement. No movement. So dash and dash. Still, this figure will go to non-current liability because there's a figure there. That's all. Now let's continue. What if it's like this? The closing balance is dash. No deferred tax liability at the end of the reporting period. You were informed that there's no deferred tax liability at the end of the reporting period. But in a trial balance, in fact, the opening balance can be found in what? The trial balance. So check the trial balance. If you see deferred tax, that is it. It's also called provision for deferred tax. That means here must be 25. I have to subtract because what can I do to the positive 25 so that I can get what? Dash or 0. I have to subtract 25 from this to give me 0. So that means here I've what? Subtract 25. That is it. Now the next show is what if here rather is 20 and the opening balance is dash. No deferred tax found in the trial balance. Okay, so that means what should I add to 0 so that I can get 20? We'll have to add 20 to it. Here must be what? 20. Well done. So now we know how to calculate the deferred. And now let's go into detail the real meaning. The deferred tax is a accounting measure but not a legal measure. We will explain all this. Now let's see. We are now going to define deferred tax and go into detail of it. And then we will come across how to calculate, how to find this figure. It's an issue. The closing balance. But open balance is in the trial balance. Oh, then that's good news. Just lift it from the trial balance and then include it here. But this figure you have to calculate yourself. Or if the examiner give you this, you have to get this one yourself. Add and get this. So take note. So let's go to deferred tax. So deferred tax. Deferred tax. Deferred tax. So let's start the definition in terms. Deferred tax. Now, before I explain or I define it, I will probably walk you through some few illustrations for you to get the description or the explanation first before you look at the technical definition for deferred tax. Good. Good. Now let's see. Let's assume that we are in December 2019. We have done our financial statement. And there's one particular transaction. This transaction, the value is 1,000 Ghana cedis. The value is what? 1,000. Let's assume that a customer bought goods from us. He's a regular customer, so they will know him very well. So we can even give him credit up to 2 years. He'll come and pay. One day when he come and pay everything. I'm just assuming that it's 1,000 cedis. The value is 1,000 cedis, which will be paid exactly 2 years. Okay, let's make it exactly 1 year. In fact, it can be in future period. Okay, you pay after 1 year. So let's say 2 years time. So 2020 December and 2021. So you pay us in 2021 December. That's where this customer will pay the money. And one fact too is that tax authority, they tax on cash receipts. Most of the tax authority, yes, in the various countries, they tax what? When you have the money. You don't want a situation whereby they will tax you and say, oh, please, I've not received the money, so you don't have anything to pay. You can't use your personal money to go and pay. What if the customer doesn't bring the money? So they can do something about it. Good. Now the issue is this. To realize that The tax effect of this transaction, 1,000 Ghana cedis, credit sales. In taxman's book, he will tax you this 1,000 Ghana when the customer bring the money in 2021. Let us know your tax rate is 20%, which is what, 200 Ghana cedis. So that means in 2021, you are going to pay tax on a transaction which has already occurred. Trouble. There's a danger. Why? Because they are going to tax you extra. You pay extra tax of what? 200 Ghana cedi in 2021 as a result of what? The credit sales made. So the question is, in accounting, anytime you see that there's a danger coming, you make accurate and enough provision towards the danger. But when there's a joy or when there's a good news coming, we'll tell you that wait, let the joy come before you what capitalize it. So look at what we will do. Okay, then let's record it in our books as tax. Let's make a provision for it in our book. And then defer the payment later when the customer bring the money. So that's deferred what? Tax. So this 200 is the deferred tax provision. So deferred tax simple mean simplest terms, transaction which has already occurred. It has occurred in December 2019 or previously. So either in the current year or previous years. Have you seen? Either it has occurred this year or previous year, but it will let us pay tax more or less in future. The transaction has already occurred, and we know that its tax effect will not take place now. It will take place what? Subsequent dates or subsequent financial statement, or then it will create what you call deferred tax, like this illustration. Good. So that is it. So in simple explanation, deferred tax refer to the amount of tax that we have to pay, or the amount of tax that they will deduct from our tax liability in future as a result of what? Current or past transactions. Now that we know the explanation, the issue being and deferred tax, it's like you bring it to today's terms and deferred it into the later periods. This deferred tax is not tax which has been deferred. No, it's not tax that you're supposed to pay that you have deferred it in future. No, not at all. That's not deferred tax. This 20% on 1,000 Ghana, 200 Ghana cedis, you pay it when the customer bring the money, which is 2021. Not in this today's financial statement. Even though you've earned this money, because you've not received the money, tax authorities books, you are not owing them 200 Ghana. So that's not. So we shouldn't picture it as if we're supposed to pay this 200 Ghana cedis today, and we say we don't have money. So let's defer into future date. No, that's not the issue. The issue is this. Yes, the transaction has taken place today or previously or previous year, but the tax effect will happen or will occur in future periods. Then let's bring the tax effect in today's terms so that in future the tax authority call us for come and pay the 200 Ghana cedis. We won't scratch our hair. We have make what? Adequate or enough provision for it. So that is it. But rather, even though we have what? Presented it in this year's financial statement, they are not going to pay it. We could have told Jerry that, oh, take the money, take the 200 Ghana cedis, let's pay the 200 Ghana cedis. So that when the customer come, you won't come and then stand on our neck. No, we won't do that. But if not receive the money, what if the customer did not handle the payment? That means we've already paid the tax to government. We know that tax paid to, it's not easy to refund it back to you. And they will not understand. They'll ask you to go and chase wherever the customer is, go and chase him and then take your money. That is it. So we have not paid. That's the another section. We've not paid. We have deferred it into what? The future period. Good. We've deferred it into what? Future period. So that's what we mean by what? Deferred tax. Now let's take the definition. The definition for what? Deferred tax. Good. Now deferred tax is the estimated future tax consequence. Estimated what? Future tax consequence of transactions and events recorded or recognized in the financial statement of the current year or the previous periods. So it's the estimated future. Estimated future. It's an estimate, not actual. You were estimating that the guy will bring 1,000 Ghana. What if maybe he said that, oh, please, in fact, things are not good. So even though I owe you, I promised 1,000 Ghana. But let me give you 800 here. It's an estimate, it's not actual. Good. Because it depends on the amount you are going to receive from the person. Good. So it's an estimated future tax consequence of what? Transactions and events recorded in the books, both in what? Whether current year or previous periods. That is it. Now, as soon as you mention deferred tax, there are two concepts of profit that normally comes to mind. Let's do justice to them. First, you should know the two types of profits. You have what we call taxable profit and what? Accounting profit. So taxable profits, accounting profit. What's the difference? Accounting profit. Let me start with accounting profit because that's what most of us are familiar with. Accounting profit is a profit determined in accounting books using what? The accounting laws. That's the IFRSs. So that is the profit determined in the company's financial statement using what? Using the IFRS. So preferably, there are so many types of the accounting profit. Let me take the most common one. Profit before tax. So accounting profit is a profit determined in the accounting book. One. Two, using what? The IFRSs. So any profit determined in accounting books using what? Accounting laws or the accounting standard is accounting profit. We are done. What about taxable profit? Taxable profit. They are the profit determined by what? The tax authorities after examining the account using the local laws. Local what? Tax laws. So after applying the tax laws on the financial statement and they've determined the profit which is liable for tax, that is the taxable profit. So we are saying that taxable profit is a profit determined by who? The tax authority. So one, profit determined by what? The tax authorities. After examining what? The account. After examining the account, using the tax laws, local tax laws, on which the tax liability of the company will be determined. The tax liability or the final tax liability will be calculated on the taxable profit, not on the accounting profits. How we get it? So normally, I call this one taxman's profit. Taxman's profit, and I call this one accountant profit. Yes. So taxman's profit and accountant profit. So the tax liability of the company will be based on what? The taxable profit. You are done. Great. Now let's see. These two profits, would they be the same or they'll be different? Yes, because the bases are not the same. One uses IFRS, accounting profit use IFRS to determine it. They use the tax laws. So if the provisions stated in these two regulatory bodies or these two laws are not the same, then it will create difference. In fact, there's difference. We have grouped the difference into two. The first difference, we call it what? Permanent difference. Permanent difference. Permanent difference. Permanent difference. Good. Great. Now, permanent difference is the one-off item that causes a difference between the taxable profit and accounting profit due to what? Due to the fact that one party accepts and one party ignores. Good. So any transaction that it is allowable by a taxable by the tax authority, but the accountant will not record it to create what? A permanent difference. So in fact, permanent difference, there's one transaction. Accountant like it, tax authority doesn't like it to create a difference. One transaction, tax authority like it, accountant does not like it. So to create what? A difference. So that is it. Now, this one, it only affects one period. It affects normally one period. It does not like balances that the closing balance will affect open balance of the next year. No, that is it. So that's the permanent difference. Example include one, entertainment expense. Let me give you an example. I know the tax authority, they don't agree with entertainment expense. So any entertainment expense that you incur, any entertainment expense that you incur, if you expense in a P&L, they will disallow it. They will reverse it. Yes, because they will not agree. Because they will tell you that it is not what necessary. Entertainment expenses are not necessary to be incurred. Because they use the three factors: necessary, wholly, and what? Exclusively incurred. So these are the three terms. And then entertainment expense does not pass the necessary and then the exclusively. And hence they will not allow you to deduct it. So they'll add back. So when they add back, it will create the difference. Because you will subtract from your profit to reduce your profit for you, they will not. So the profit will go high. And then some of the donations, not all donations are accepted by the tax authority. So donations, any donation that do not have a national character will be disallowed. That means if you want to donate and record it in the books, make sure that that donation have what? National character. National character means something that will help the entire nation or will help majority. So like you want to donate to maybe a sports club, maybe Kotoko or House of Folk or Chelsea. They say no, if you donate to Chelsea, it will not help the country. So if you want to donate to help the country, donate to the national team. So the national club, that's the Black Stars or Black Queens. Good. That one they will allow you. Or even if you want to donate to homes, children homes, or any NGO, it must be a registered home or NGO in the society registered by the district assembly. Aside all this, any donation made to such institution would be what? Disallowed. That is it. We are done with the permanent difference. Please, permanent difference does not cause what? Deferred tax. Permanent difference does not cause deferred tax. So that is it. Now let's go to the temporal difference. So the difference between these two are grouped into two. Some of the differences are permanent. They are one-off transaction. They don't repeat itself, one-off. Entertainment expense, 1,000 Ghana cedi for this year. Must disallow it. That's all. Accountant will allow. Tax authority will disallow. Then the next one is temporary difference. So temporal difference. Now, temporal difference, here let me explain before I give the definition. In fact, both the accountant and the tax authority accept it, see it as it is an asset. All of them agree that this is an asset, this is an expense. All of them agree. All of them allow, all of them agree. Just that the time is different. So normally it creates a temporal difference in the financial statement. So let's assume that you have assets. You have assets. The timing of this asset, the value of this asset for tax purposes and for accounting purposes may be different. So let's say you have a building. Yes, of course. When the tax authority see building, they will see as building. They won't see as for stones or mere sand. No. They also see as what. So let's see the accountant or the books. Accountant sees this building. The value is, let's say, 40 million. Accountant said that this building, they are going to use it for 50 years. 50 years. And then the tax authority, they said, no way. Sir, the value, you also agree that it's 40 million. You bought it at 40. No P. Don't worry. But the 50 years is too much. This building, oh, it should be for, let's say, 10 years. Good. The life should be 10 years. So because you are using 50, depreciation based on 50, capital allowance is based on 10 years. So to create a difference, now which one have the shorter time and then the longer? If I the one that will last longer with that of the accountant. So let's say give it 50 years. So in the 10th year, at the end of the 10th year, the asset will be scrapped off from the books of what? The accountant. The asset will be what? Scrapped off from the books of what? The accountant. And then after 50 years, sorry, from the books of the tax authority. So the tax man will scrap it after what? 10 years. And then after 50 years, accountant will scrap it off. So the difference is temporal. If it's a matter of time, it will take off. What if accountant also say 11 years? Okay, so at the end of the 11th year, the asset will be off from both accountant and the tax authority. So how we get it? So here, in short, all of them see that item, but the timing, the time that this guy will say it, no, the day that this guy will accept it, the other party will not accept it, and it will create a difference. Good. So now let's see. Now, the temporal difference is the one that creates the deferred tax. Yes. So temporal difference created to a deferred tax because the illustration that I gave, someone is owing you 1,000 Ghana. You made a sale today, and the person come and pay to you. So in your book, you record it as what? Receivable, trade receivable of what? 1,000 cedis. Accountant say, no way, I've not seen it. Until the person what? Gives the money. So it becomes zero. All of us see that as allowable item, but until certain time, the time that the accountant record it is different from the time that the tax authority will record it in his books. That creates difference. So the next year, it will be off from the accountant's book, and then all of them have 0, 0. You are done. So that's the temporal difference. Now let's see the definition for the temporal difference. Now, two items creating temporal difference. The difference is temporal. Just give it the longest time. It will just vanish from the book for both the accountant and then the tax authority. Two items causes temporal difference. So in the two items creating deferred tax. Assets and liabilities. It's not expensive, so assets and what? Liabilities. They create what you call temporal difference. So let's define temporal difference. So temporal difference is the difference between the carrying amount or tax base. So difference between the carrying amount or accounting base of an asset. Difference between what? Carrying amount or accounting base. Accounting what? Base. Difference between carrying amount. Difference between carrying amount and the accounting base. Difference between carrying amount. For the carrying amount is the same as for the accounting base. So if you want to determine the temporal difference, it's the difference between the carrying amount of an asset. So carrying amount of what? Of assets or liability. For an asset or liability and its tax base. And its what? Tax base. And its tax base. So in short, compare two items. So the tax base and accounting base, the difference is what you mean by what? The the temporal difference. So the example that I cite, so from the definition, you get two items, accounting base. Accounting base, I will call it accountant's value or the book value. Book what? Value. The value of the asset in your book, the company's book. We call it the carrying amount, CA. Chartered accountant, come again. Yes. Not right again, no, it's come again. Good. Now, versus what? The tax base. Tax base. So for tax purposes, the value for tax purposes, or in a taxman's book, what's the value has it stated in it? So anytime the company is having asset or liability, there must be a corresponding value in the tax authority's book. If the corresponding value in the tax authority's book is not the same, they don't tally. Oh, then you create a temporal difference. Oh, yes. So that is it. So let's assume that you have a building assets. The value is 400 million. And then that of the tax authority said, no way, this value, not at all. But we see it at 320 million. That's it. So there's a difference, eh? Great. So this difference is called temporal difference. It's 80 million. That's what? The temporal difference. So temporal difference. So that is it. Okay. Now, there are two types of temporal difference. Depending on the item in question. Depend on what? The item in question. So now let's see. Now, assuming that the item in question is an asset, is what? Assets. But let me do I want to bring it a bit closer here. So let me say carrying amount slash book value. I don't write plenty of book value. Or accounting base versus tax base. I wrote assets here, maybe building. 400 versus 320. 400 versus what? 320. So there's a temporal difference. Now, if it's an asset and the accounting base or the book value is greater than what the tax base, or the book value is more than the tax base, in your books, you are stating at 400. The tax man say, no way, you have 220. Oh, so what you are stating, that means you are overvaluing your asset too. You are overvaluing your asset. That means therefore less has been subtracted for the tax purposes, so more will be taxed in future. Now the issue is this: it will create what we call the difference of 80. It's a temporal difference, but we call it taxable temporal difference. So we call it what? Taxable temporal difference. Meaning in future, the tax authority will call you that please come, and then they will tax you in future. So that's the taxable. So have you seen the game? As soon as the carrying amount of the asset or the book value of the asset of the property more than the tax base, it will create what we call taxable temporal difference. What if it's the other way? Maybe the carrying amount is 500. It's rather lesser than, in fact, let me write it here, 80, then write against it taxable. So that this one I can also write it there. And here is what the current amount is what rather lesser. So here's somewhere 700. So here's what 200. But we call it what deductible. 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 So deductible. So deductible temporal difference. So this is the temporal difference. Temporal difference. So either it will be taxable or deductible. Good. So deductible. So take notes. We said that the balance carried down of the deferred tax that we did. Opening balance so much, closing balance. This one can be a non-current liability or non-current liable asset. It depends on what the temporal difference. Now, taxable means it will create what we call deferred tax liability. So non-current liability. Deductible are non-current what? Assets. How we get it? Good. Deductible simply means in future, the tax authority will take it from your profit or subtract it from the tax that you're supposed to pay. So that is it. So it's like a gain for you. Like in future, whatever you're supposed to pay, but there's a credit, there's a plus for you. So that's an asset. I'll be get it. But it will result to what? Inflow of what? Future economic benefits. Yes, it will save you from paying certain amount. Great. That is it. Now, let's now learn how to calculate the deferred tax. But I'll do another section again before that. In fact, let me see. Okay, I'll do that one here. Deferred tax is nothing by the temporal difference multiplying by the tax rate. So the temporal difference multiplying by what? The tax rate. For the tax rate, it must be the current tax rate or subsequently enacted tax rate. Either the current tax rate or the subsequently enacted tax rate. So that is it. So to get a deferred tax, so if I want to get a deferred tax at the first section, let us know the tax rate is 20%. Tax rate is 25%. So I'll tell the examiner that, open balance of the deferred tax so much. Closing balance is nothing by the 80 million times 25%, that's the deferred tax provision at the end of the year. I'll be getting is what? The tax rate times what? The temporal difference. You are done. So you have to give us the to give us 80 times 0.25. Oh yeah. So times 0.25. That should give us 20. So therefore, the deferred tax provision is 20, and that's the closing balance. Now you compare this to the open balance. Maybe the open balance is 30. Oh, it has reduced by 10. And you send it to what? The P&L. And then you are done. So that's how we're going to do. Thank you very much. We are getting to the end of the program. Getting to the end of the program. So that is it. Now let's continue. What if it's a liability? It's a reverse. Don't even worry yourself to memorize everything. Just learn the first one. The opposite is true. Okay, the first one suggests that if it's an asset and the current amount is more, it's taxable. If the current amount is less, it's deductible. L, what I've said, the reverse is true for what? A liability. The reverse. Because if you are not an asset to the family, then obviously you'll be a liability to the family. That is it. If you're not an asset to the family, then obviously you'll be a what? A liability. Don't tell me that you'll be an expense. No. Not you. Oh. Different person, not you. Not you. Either your asset to the family. Good. So that is it. So liability is a reverse of what you've done. If it's a liability and it's more, the current amount is more than the tax base. Oh, then over here is taxable, right? So now here the reverse of taxable, that's deductible. So this 50 becomes what? Deductible. How we get it? This becomes what? Deductible. And then if the current amount of the liability is rather less than what? The tax base. Let's say 200 here versus what? Versus 300. So that one becomes what? Taxable. They will tax you in future. That's the difference. We are done. So that's the end of the IAS what? IAS 12 income tax. So please, in the question solving stage, try and be part of us where we'll be solving the actual issue. Good. The actual issue. Continue watching the video and you smile in the exam. Good. So in summary, IAS 12 explain how the income tax expense stated in the financial statement will be calculated and recognized. That's a summary. So the income tax expense that we see in summary is made up of 3 items: the current year tax, under or over, deferred tax. Please, deferred tax is an accounting measure. It's what? Accounting measure. It means as an accounting term, not a legal measure. So it means that in the tax law, there's nothing like deferred tax in our tax law. No, not at all. It's only in accounting, financial books that you see deferred tax. Yes, because when you realize that there's loss coming towards you, you make adequate provision for it in accounting. Prudence. Good. That is it. So much. If it's over, you subtract deferred tax movement, will come here, then you finally add it. Where this deferred tax is nothing by Opening balance so much, closing balance so much. The movement goes to P&L, and this is what we are going to put here. I'll be get it. Good. So that's the deferred tax calculation. That's the deferred tax movement. So I'll project some few illustrations that we are going to look at it at the question solving stage, and then you'll be fine. Kindly go through for me. Kindly go through for me, and then you are fine. Okay, I'll probably solve one. Yeah, one example. Good. Now let's go in for it. Okay, here comes the example. Just that this one is for over or under. Now, Target PLC has estimated its income tax liability for the year ended 31st December 2018 as $180. Good. So the current year is $180,000. In the previous year, when they mention previous year, our minds should go to under and over because you can only confirm previous year, you can't confirm this year's own. Great. In the previous year, the income tax liability had been estimated as what? 150,000 required. Calculate the tax charge. Tax charge that will be shown in the statement of profit or loss for the year ended 31st December 2018. If the amount that was actually agreed and settled with the tax authorities in respect of 2017, that's previous year, right, was 165. So this is the tax agreed and this is the tax provided. That's all. So now let's see. First illustration. Illustration 1. Now we've entered into what? Question solving. Illustration 1. So A. I need my C, U, or O, and then the D. This question there's no deferred tax, so I'll bring dash there. Now the current year tax, we're informed that it's 180. To get the under or over, let's work in here. Tax provided and tax agreed. Final tax agreed. The tax provided was what? 150. Great. Tax agreed was 165, coming from the question. So have they over provided or under provided? Let's confirm from the question. Then you are fine. Tax provided is what? 150. Tax agreed is 165. So are they over or under provided? You can see. Okay, they provided lesser than the right one. This guy is the right one. So they have what? Under provided by what? 15, the difference. 15. So here, I'll put 15 here. 15,000. You are done. Putting all these two together, that's 195,000. That's the income tax expense that will be charged to the P&L for that particular year. That's for the A. That's great. So let's see. Then we go in for the second one. Now they agreed on 140. Okay, 140,000. So I have to change this guy. So provision is still, the current year provision is still 180. Now they agreed on 140. Okay, they provided 150. And the tax authority said they should pay what? 140. Okay, so that means over. They provided more by what? 1,000, 10,000. So that becomes over. So here will be over 10,000. You less, get 170. You are done. So that's the end of the question. And then we find now what left is taxation of what? Revaluation. Taxation of revaluation. Yes. I'll do that when we are done with the IAS 16 or in the question solving. I'll do that in the question solving. So there will be a separate video on, we call deferred tax on revaluation. deferred tax on revaluation. In fact, wherever the revaluation gain is going, the tax must follow him. That's all. That's a treatment. So if the revaluation gain is going to the OCI, then the tax component must also go to the OCI, not to the P&L. If the revaluation gain is reversing some loss in the P&L, then the tax component on that valuation or that gain must also follow him towards the P&L. That's the end of the game. I'll back it with illustration in our subsequent meetings. Good. Now let's see if we can get some more illustration. We can get some more illustration. Now let's go to the past questions and then let's see our past questions. I want the most recent one. Let me quickly go there. Good. You will try this for me. Let's go through the compiled past questions. This is November 2015. So we are going to May 2016. Cool. So this May 2016. Great. Let's see. Yes, May 2016 question was 1. Zillow Limited. Zillow. So let's come to a travel and see if you can see some tax issue. Yes, I can see deferred tax. Good. So that's the open balance 5,200. So we should go to note what? Note 4. Now let's go to note 4. Let's see what is there. The directors have estimated the provision for income tax. Provision for income tax for the year ended 31st December 2015. Let's go and say year in question first. Year in question. We are paying for 31st December 2015. Oh, okay. So that means that's the current year tax what? Provision. Great. Current year tax provision is what? 8 million. The deferred tax provision at 31st December 2015 is to be adjusted through P&L, through profit and loss statement, to reflect the tax base of a company net asset, which is 12 million less than the carrying amount. Wow. Now try this one for me. Now we will solve this question. They are saying that the deferred tax provision at 31st December 2015 is to be adjusted through the profit or loss statement to reflect the tax base of the company's net asset, which is 12 million less than the carrying amount. Wow. That means they've already compared the tax base and the accounting base, and they've determined what the difference already. So they are saying that the tax base of the net assets. So the item in question is what? Assets. Tax accounting base and tax base. Now they're saying that the tax base is lesser than the carrying amount of the net assets by what? 12 million. Okay. So this is lesser than this by 12 million. Don't even worry yourself. You go and assume that, okay, so if the accounting base is 36, then the tax base must be what? 24. Do not give 12. Or if here is 24, here must be what? 12. If here is 12, here must be 0. Do not assume this next time. It's a waste of time. They've already performed the calculation for you. So just pick it and multiply by the tax rate to get the closing balance. So therefore, the temporal difference is what? 12. They said it is lower than the accounting base to let you know which one is higher. That means the tax base is lower, or the accounting base is what? More. So this one is what? Taxable temporal difference, which is creating what? Non-current liability. That's all. Deferred tax liability. So that is it. Now let's see how best we can solve this question. So I'll start. solving every aspect. So I write my workings, maybe income tax expense, as usual. As I write this one, I'll do something like this: under or over tax, deferred tax. We're told in the question that the current year tax provision is what? Let's read three zeros: 5,200. Under or over, there's no under over in this question, so I'll throw dash. Deferred tax, after the examiner, workings number one. Let me go to the workings and bring it back. So I'll underline it like this. It's okay, deferred tax calculation. Deferred tax calculation. Open balance. No, this one is not 8,000. It's not 5,200. But let's go and pick it from the question. I think that's the balance for the deferred tax. So three zeros. Open balance is 5,200. Where you have to pick it from the trial balance, TB. Open balance and the trial balance. If it's not in the trial balance, it's not given to you. So the open balance must come from where? The trial balance. Now let's go to the question. So from the trial balance, the deferred tax is what? 5,200. That's the open balance. Good. So that's what we have here. Open balance. Now let's go to the footnote. Whatever they inform us, we work on it. Now note 4. Directors have estimated the provision for income tax for the year, for the current year. If they don't state current year in the question, they will quote the year for you. So take note. In the current year, which is what? 8 million at 8 million. So that's 8,000. So let's go and put in. It's 8,000. No under or over. Why? Because I can't see current year tax in the trial balance, and the footnote, they didn't say anything about it. So you are done. Now, the deferred tax provision at 31st December 2015 is to be adjusted through profit and loss to reflect the tax base of the company's net asset, which is what? 12 million less than their carrying amount or the accounting base. Tax rate is what? 30. Okay. So I'll write here closing balance. So closing, open my bracket. The 12 million, that's 12,000 times what? 30%. Good. That'll give us, so 12,000 times 30%. In fact, let me shift this one here small so that I can write big, big, big for you to see. So 12,000 times 30%. That'll give us, so here's 5,200. Should give us something like 3,600, right? Good. That's 3,600. So have you seen what we did? Open balance is here, closing balance is there. Open balance 5,200, closing balance 3,600. So what's the movement? Is there any movement? So it must be reduced by what? 1,006, eh? Agreed. Will it be 1,006? But it must be reduced. Great. So what will be the movement? Try. Good. So 1,006, right? And then you put in brackets. So write 1,006 here. Because I have to subtract. What should I do to the 5,200 so that I can get this 3,000 and subtract 1,006 before I can get this? Then, in fact, this is the open balance. And then the heading is the deferred tax. Thank you. So P&L, if I get the balancing figure, they say it must move through P&L. You put 1,006 here, and I put it negative. If the same figure must come here, you are done. How we get it? So the same figure must be there as what? As deferred tax. So at the end of the day, I'll sum all up. 8,000 plus 0 less 1,600. and this figure goes to the P&L as what? Income tax expense, and that's the end of the game. So compare the opening balance to that of the closing balance, the movement, send it to the income tax calculation. So you take 1,006 from 8,000, that will give us 6,400. So that means the income tax expense for that year will be 6,400. We are done. Great. So that is the end of the game. Now the remaining parts, when we meet at the question solving stage, we'll go through all of them and then you'll be fine. Now thank you very much for coming. Kindly subscribe and then watch the remaining video and get the lecture material or the handouts or the questions too. You can request for them. Thank you. Goodbye.